5 ways to diversify your investing portfolio. 1. Spread the wealth. Equities can be wonderful, but don't put all of your money in one stock or one sector. Consider creating your own virtual mutual fund by investing in a handful of companies you know, trust, and even use in your day-to-day life. But stocks aren't just the only thing to consider. You can also invest in commodities, exchange-traded funds, ETFs, and real estate investment trusts, REITs. And don't just stick to your own home base. Think beyond it and go global. This way, you'll spread your risk around, which can lead to bigger rewards. People will argue that investing in what you know will leave the average investor too heavily retail-oriented, but knowing a company, or using its goods and services, can be a healthy and wholesome approach to this sector. Still, don't fall into the trap of going too far. Make sure you keep yourself to a portfolio that's manageable. There's no sense in investing in 100 different vehicles when you really don't have the time or resources to keep up. Try to limit yourself to about 20 to 30 different investments. Point 1. 2. Consider index or bond funds. You may want to consider adding index funds or fixed income funds to the mix. Investing in securities that track various indexes makes a wonderful long-term diversification investment for your portfolio. By adding some fixed income solutions, you are further hedging your portfolio against market volatility and uncertainty. These funds try to match the performance of broad indexes, so rather than investing in a specific sector, they try to reflect the bond market's value. These funds often come with low fees, which is another bonus. It means more money in your pocket. The management and operating costs are minimal because of what it takes to run these funds. One potential drawback of index funds could be their passively managed nature. While hands-off investing is generally inexpensive, it can be suboptimal in inefficient markets. Active management can be beneficial in fixed income markets, for example, especially during challenging economic periods. Point 2. 3. Keep building your portfolio. Add to your investments on a regular basis. If you have $10,000 to invest, use dollar cost averaging. This approach is used to help smooth out the peaks and valleys created by market volatility. The idea behind this strategy is to cut down your investment risk by investing the same amount of money over a period of time. Point 3. With dollar cost averaging, you invest money on a regular basis into a specified portfolio of securities. Using this strategy, you'll buy more shares when prices are low, and fewer when prices are high. 4. Know when to get out. Buying and holding and dollar cost averaging are sound strategies. But just because you have your investments on autopilot doesn't mean you should ignore the forces at work. Stay current with your investments and stay abreast of any changes in overall market conditions. You'll want to know what is happening to the companies you invest in. By doing so, you'll also be able to tell when it's time to cut your losses, sell, and move on to your next investment. 5. Keep a watchful eye on commissions. If you are not the trading type, understand what you are getting for the fees you are paying. Some firms charge a monthly fee, while others charge transactional fees. These can definitely add up and chip away at your bottom line. Be aware of what you are paying and what you are getting for it. Remember, the cheapest choice is not always the best. Keep yourself updated on whether there are any changes to your fees.